Hello, everybody. Welcome to the webinar. I'm your host, Julian Klymochko. Today, we are talking about SPACs. That's right. The webinar today is your guide to special purpose acquisition companies. We've got a lot of data to get through today. I'm going to run through it relatively quickly. If you do have questions, you'll see a chat box. Throw any questions in the chat box. I'll get to the questions at the end of the presentation. Should be roughly 40 minutes or so. And I'm excited to get into it today, so let's start out. First off, of course, got to read the disclaimer, forward-looking statements, etc. Have a close read of that and be aware of all the disclaimer potential issues. But let's get into it. So taking a high-level view, if we go back and an overview of asset management and capital markets over the past, let's say, 50 years. Each decade was really characterized by specific financial innovation. For example, if we go back to the 1980s, the go-go 80s, characterized by the leveraged buyout boom, which really emerged at that time. And the specific financial invention that was feeding the leverage buyout boom was the high yield bond, or the junk bond, invented by Michael Milken. It really came to represent the 1980s as the supercharged environment, leverage buyouts, corporate raiders, etc., all fueled by high yield bonds, which before that point had never really been a thing. Then fast forward to the 1990s. The 90s were the era of the mutual fund. You had star mutual fund managers like Peter Lynch and Michael Price writing best-selling books, being on the cover of magazines, and the mutual fund really represented the 1990s. If you're investing back then you probably owned some, or your parents did back then, as did mine. But that was really the way that investors, everyday investors, accessed equities and bonds, was through a mutual fund, which obviously has changed dramatically since then. Then in the 2000s, we really saw an explosion of exotic credit products such as CDSs, credit default swaps, CDOs, MBS, mortgage-backed security, etc., which fueled a credit binge focused on residential real estate. Blew this big housing bubble, which ultimately ended badly in 2008 with the insolvency of Lehman Brothers and big bear market of the great financial crisis. But the 2000s really had those exotic credit instruments come very, very popular. 2010s, I think it's fair to say that the 10s were characterized by the ETF, really democratization of access to cheap investing, easy, liquid index funds. Everyone owns them, everyone loves them, super easy to use, and that is the benchmark. So ETFs really proliferated in the 2010s, specifically plain vanilla ETFs. In 2020, obviously the jury's still out, still early on, but I'm making the case that perhaps the 2020s will be characterized by the SPAC. So what exactly is a SPAC? Well, it's an acronym for Special Purpose Acquisition Company, effectively just a blank check. It does its own IPO, initial public offering, and then you have a cash-rich shell company with no operations, but a mandate to do a business combination with a private company and take them public. They typically have a fixed period to do that and effectively serve as a vehicle or a conduit to bring a private company public. Now, SPACs have fairly standardized structures, aside from the odd one that chooses to be different, but they're generally almost all structured the same. That is an IPO at $10 per unit. Notice how I said unit, not share, because a unit is basically stapled of two securities, one common share per unit, and then a fraction of a warrant. Everything from 1/5 of a warrant to 1/4, 1/3, all the way to a whole warrant per unit. So meant to incentivize investors to participate in the IPO by getting this additional value or additional equity upside. Strike price of that warrant's always at a 15% premium to the issuance price, so at a $10 per unit IPO, warrant would be struck at $11.50, typically with a 5-year term. And then what's unique to SPACs is that after 52 days, the investor has the option to split them into their constituent parts, shares, and warrants. And the way that SPAC functions is they raise this $10, say it's a $200 million initial public offering. All of that goes into trust where they can't touch the money. And in trust, they invested in short-term treasury bills. So the safest security they can find, and they can't touch it aside from paying taxes on interest on those treasuries and affecting the business combination. A SPAC has a fixed time frame, generally 24 months, but sometimes less, 12 or 18 months, but most of them are 24 months. And it features two unique structures. One is if they don't get a deal done in that time frame, they return investors' money, which is $10 plus accrued interest. So it's effectively, in the worst case scenario, you get the yield of a treasury bill. And if they liquidate, then your warrants are worthless. But if they announce a deal, then investors get to vote on the deal. And if they don't like it, they can redeem for $10 plus accrued interest. So there's those two unique factors to a SPAC that makes for an interesting arbitrage opportunity. The asset class has really proliferated this year. I think at the start of the year, there's maybe 100 SPACs, and now there's nearly 300. Touching more on the explosion in SPAC issuance in 2020, obviously they're very popular these days. You hear a lot in the media about this new asset class, and there's been absolute frenzy in issuance. For example, in 2019, at that time, it was a record haul of 12 billion of SPAC IPOs. But if we look just at October of 2020, raised almost 18 billion in 1 month. And in the first 9 months of 2020, SPAC IPOs have raised over 40 billion. And at this point, I believe we are in excess of 60 billion. So a massive frenzy in SPAC IPO issuance, which has been caused by a couple factors that I'll get into. If we rewind 8 months ago, back in April, SPAC asset class was $25 billion and now represents an asset class of $100 billion. So it's quadrupled in 8 months, which you don't see that very often. And that's one reason why you should pay attention to this asset class, because it's changing dramatically and it's starting to become a massive part of the market. If you look at the graph on the right, monthly SPAC issuance was kind of in the 1 to 2 billion range up until late spring. And then in the summer, it's just gangbusters, north of $10 billion per month. And then the largest month ever in October, 18 billion. And even in the first 3 months, the first 3 days of December, we're up to nearly $3 billion, which is a pretty swift pace. So many people ask, why SPACs? Like, what are the purpose of these? Well, as I indicated, they're effectively a conduit or a vehicle for a private company to go public. And when a private company is considering a going public transaction, there's typically 3 ways of doing it. Number 1 is traditional IPO. And over the past 20 years, we've largely seen the traditional IPO become a VC and private equity exit vehicle, where they're looking to offload their stakes in a company because there's no more growth. So they harvest all the growth in the private market and they go public, sell it off to public market investors when there's really no growth left in the company. So that's largely what the traditional the traditional initial public offering has become. Then there's the direct listing, and we've seen this, a few times. You saw it with Slack, you saw it with Spotify. This is only for the most well-known private companies that don't need to raise capital, because a direct listing does not come with a capital raise. Presumably, they have a lot of cash from financing in the private market. Then lastly is the SPAC, or the blank check route. It represents, it's sometimes classified as reverse merger and presents an alternative to the traditional IPO or direct listing. Obviously, if a company needs capital to fund its growth, it won't go with a direct listing. And if it's looking for shareholder exit, they'll go the traditional IPO. But if they're a growth company looking to raise capital from the private markets, it's likely they're going to choose a SPAC because a SPAC presents certain competitive advantages over the traditional IPO, which I'll get into in this presentation. When we talk about the boom and the frenzy in SPAC issuance this year, it's a confluence of two factors. One is on the demand side, the other on the supply side. Now, on the supply side, entrepreneurs, asset managers, and other business people have really caught on to the economics of issuing SPACs, which is perhaps the most lucrative vehicle most have ever come across in their life. The reason is when you sponsor a SPAC, you get up to 20% promote, and a promote means 20% of shares in the SPAC once you complete a business combination. So say you're doing an $80 million IPO, the sponsor would be allocated up to $20 million of stock. And when you're seeing the average SPAC IPO, nearly $400 million, that's compensation in line with roughly $100 million, which is tremendous for doing one deal. It's likes of which we've never seen before. And so it's no wonder that pretty much everyone has a SPAC these days looking to earn that tremendous amount of compensation. But it's not for free. They get this 20% promote for typically 25 grand. So that is near free given the tens or hundreds of millions of dollars in upside. But they do put up what we call at-risk capital. So as you recall, when a SPAC does an IPO, all the proceeds go into trust, yet the SPAC does have expenses. So what the sponsor does is they inject capital into the blank check company, typically 2 to 4% of IPO proceeds. So say it's a $100 million SPAC IPO, they'll put in $3 million, generally in the form of private placement warrants struck at the 15% premium. So if they don't do a deal and liquidate, not only do they lose their promote, but they lose the millions of dollars in at-risk capital that they put up. So that is a major concern. But given the tremendous compensation that is just pretty exceptional if you can get it, the structure has become popular with alternative investment management firms such as private equity, such as Apollo, TPG, hedge funds, Pershing Square, Starboard, and venture capital firms such as Social Capital and Dragoneer. So super lucrative, and that's why you've seen sponsors rush to get as many SPACs into the market as they can, and many of these firms are just manufacturing them. They're on their 5th or 6th one. Then on the demand side, if we evaluate what's happened in the public market, specifically in the US, generally since the late 90s or early 2000s, public market listings have declined from about 8,000 to roughly 5,000. So massive decline. Meanwhile, you've had a huge increase in private capital, venture capital, and private equity. And on that side of the asset management industry, you've had a lot of early stage companies, these real fast growing companies, stay private for longer and longer, such that by the time they are doing their IPO, say like an Uber, for example, there's no growth left. All of Uber's growth was in the private markets, and when they only went public when the backers harvested all the growth and wanted an exit opportunity. So what investors, specifically public market investors, are realizing now is that SPACs represent the sort of venture capital 2.0. The reason this is happening was traditionally capital markets professionals thought that these early stage opportunities were only fit for the private markets because public market investors are too fussy. They're only concerned about the next quarter. They can't think long term, and therefore pre-profit companies or even pre-revenue companies just wouldn't work in the public markets. But SPACs have proven that is pretty much the complete opposite. There's a massive demand for these Series D/E type late stage venture capital opportunities that have gone public via SPAC. And a lot of these names here have recently announced SPAC deals, and they've traded tremendously well. Their valuations generally double. ChargePoint, QuantumScape, Rush Street, Open Door, Hyliion, Lordstown, Velodyne, LiDAR, any of those names, the stocks have traded extremely well. So it shows, hey, there's this demand side of the equation that is absolutely tremendous. And so that's one of the factors leading to a massive influx in SPAC issuance. Now, why would a private company utilize a SPAC over the traditional IPO? Number one is speed. You could get a SPAC deal done in as little as 3 months. Traditional IPO can take 12 to 18 months. And when you're looking to go public and raise capital, time is of the essence. Markets can change quickly. I mean, from January 2020 to March 2020 was only 2 months, but in terms of the equity window being open to then being slammed shut in a matter of weeks, that is real, and it can really disrupt business plans. So speed certainly is of the essence, especially when you have more earlier stage companies. Secondly, marketability. And by I mean marketability, I mean promoting the company, not necessarily like a penny stock promotion or anything like that, but more so getting the story out, getting out the message, why investors should be interested in the stock. Now, a traditional IPO, a company files a prospectus, and they can only discuss historical data that's in that S1 filing or the prospectus. Now, with respect to a SPAC, they can go out and talk about their forecasts. And many of the companies going public by a SPAC are pre-profit, not only pre-profit, but pre-revenue. Many of them aren't set to generate material revenue until 2025, 2026, 2027. Like, we're talking about 5 to 7 years out to just generate revenue. So what is there to have investors buy off of? Well, the story is on 2027, we'll be generating $1 billion in revenue and $200 million in EBITDA. That's why investors should buy the stock. You can do that with a SPAC deal. You cannot do that with a traditional IPO. In addition, the SPAC comes with hundreds of millions of dollars in its treasury, and what we're seeing more and more often these days are concurrent financings known as PIPE financings, or private investment in public equity, that come along with the business combination announcement of a SPAC and a private company. And then lastly, certainty. When negotiating a traditional IPO, the company doesn't know the pricing until basically the night before. With a SPAC going public transaction, they negotiate with one party, the SPAC sponsor, and they know the valuation, and they know how much cash is in there. So there's a lot more certainty around that. And obviously in capital markets, certainty is beneficial. Wanted to touch on some market dynamics here. We up until November, you had a bit of a lull in the market. This massive issuance really weighed on price action, but towards the end of November, you had a nice little rally up to all-time highs, and the average yield, which we track up top in the blue, it has gone from positive to negative. So that's something to consider, is that the market's traded back, yields dipped below zero, and we're back near new all-time highs. Still a tremendous amount of SPAC issuance. Last month, we were seeing many of these trade at a discount, but if we look at the chart on the right, all of these were issued at $10 per share, and nearly all of them trading at a premium to $10 per share. Two of these feature overfunded trusts, so right out of the gate, they're worth $10.10 in terms of their net asset value, which is nice to see. We're seeing some as high as $10.25 to further incentivize investors to buy the IPO. And when they're all trading at premiums like this, it really helps to have IPO access, which we do have, because we do have those relationships with some of the underwriters. I wanted to talk about SPAC arbitrage, which is a really interesting risk-reward dynamic, one of the most compelling strategies out there, in my opinion. And the way it works is there are two return streams, yield and optionality, in a SPAC arbitrage opportunity. So if we touch on yield, say you buy a SPAC at $10. Well, it holds treasuries, right? So you earn that treasury yield to its maturity, which at the most would be 2 years. Admittedly, treasury yields are minimal these days, 15 basis points, but it is a return nonetheless. Before this year, it was above 2%, which is nice. Second way to generate yield through SPACs is buying it at a discount to net asset value. If the NAV is $10 and you can buy it at $9.80, well, there's a built-in 2% return that you're basically guaranteed to earn as long as you're not forced to sell. So there's minimal downside of this trade, and it's very safe, low risk, which is why we like it so much. Then there's the optionality portion of the arbitrage. So when you're buying these units, you're receiving warrants. And in the case that they don't do a deal, which is very rare, those warrants expire worthless. But in the case that they do a deal, two things happen. Say the deal's, it sucks, no one likes it, the stock doesn't trade above NAV, and you want to redeem, well, that's fine, you get your money back plus accrued interest, but these warrants still have tremendous value, sometimes even like $1.50 per share. And if you're issued half of a warrant per unit, that's a 7.5% return on the unit, which is pretty exceptional value. In addition to that, and where the real kicker comes in the strategy and why it's been doing so well this year, is the upside optionality in the stock. And we're seeing this natural lift. When they announce a deal, typically the stock has been trading up, sometimes significantly so. We have seen some trade to $13 from 10, $15, $20, even $30 per share. Some of our SPACs have traded to. So when you get in at $10 or lower, knowing that your low risk or your worst case scenario is to get $10 plus accrued interest, if you can exit that at $30 per share, that is a pretty tremendous upside with very little, if any, downside, assuming you're not forced to sell. So we like to say that it has a risk profile of US T-bills with the upside optionality of equities. And here's an example to really showcase that. The chart on the right is Bechtel IQ, which did do a deal with Nikola, which is somewhat controversial, but that's besides the point. Because as an arbitrager, we never hold past deal completion. Once they announce a deal, we seek to exit the opportunity and crystallize that upside optionality. So what's going on in the graph on the right? The orange line, the steady line, is the net asset value. So it's slowly increasing over time because it just represents short-term treasuries that are accruing interest every day. This SPAC was issued in 2019, so that interest it was accruing was about 2%. Just on short-term T-bills. The blue line was the share price of the SPAC. So as you can see, in 2019, it was trading at a discount to its net asset value. So investors could have bought at a discount knowing that they'd earn the yield of treasuries plus the amortization of that discount. So you're probably getting a 4 to 5% annualized baseline return. But fast forward to early 2020 when you see the big upside, that's after they announced the Nikola deal. And this allowed arbitragers to exit at 11, 12, 13, even above $14 per share. That's an additional 40% return on a trade that was very low risk. And so we're really in it for that upside optionality. And even without it, the returns are great. But with that upside optionality, the returns go from great to truly exceptional. The number one reason we like SPAC arbitrage is due to its very low risk. And the reason it's very low risk because you're effectively investing in T-bills. Those T-bills are held within a SPAC, so obviously it's not as liquid, so there's a bit of a illiquidity premium there. But as long as you can hold on to maturity, you face the risk profile of T-bills. And that's one of the lowest risk securities in the world. So as long as you're buying at the right price, and by right price, I mean at trust value or net asset value or below, which is even better, your baseline return in the worst case scenario, which makes it a very low risk way to generate yield and generate returns, especially in an era with very high volatility, extremely low bond yields, and record equity valuations. So we like it because it presents equity upside combined with the risk profile of treasury bills. And some of these SPACs that have split into common shares and warrants, they sometimes trade at pretty good discounts to the net asset value. If you look at the chart here, there's 10 that offer pretty decent yields, kind of in the 2.5% to 3% range for SPACs that have not announced deals. So they still have that upside optionality. But if you're looking for a nice low risk cash rate of return trade, these are the ones that you would take a look at. This graphic really shows the mechanics of SPAC arbitrage. So if we look at recent IPOs, some are at $10 or lower, some are at premiums. When I did this analysis, 25 recent SPAC IPOs were trading at $9.99 on average per unit, meaning that you get paid a penny per share to get warrants for free and get that upside optionality. And on average, SPAC units are offering 0.46 warrants per unit, so nearly half of a warrant per unit. And if we look at the average warrant value, it's nearly $1.50. So that's like the economics are pretty exceptional behind this. We did speak of the upside optionality, and in the current markets, it's about 400 days on average in terms of timing from IPO to business combination. So certainly it requires patience and diversification, because you don't know which one is going to announce a business combination. For example, we hold 115 in the Accelerate Arbitrage Fund, and we had one this morning announce a deal, which is great to see because the units almost always trade up. So we've been buying at the IPO or in the secondary market at or below net asset value, but then if we look at SPACs that have announced a deal, there's this natural uplift when they announce the business combination, such that of the 48 SPACs that have announced a business combination, they trade at an average nearly 16% premium to net asset value. So you're getting that great value uplift to sort of generate that yield. So to summarize this, let's look at the graph on the right. Starting out, we buy the SPAC unit at or below NAV, and then time passes, they announce a business combination. You see a big uplift in the units because the shares typically trade to a premium to the net asset value just because investors are interested in that opportunity. And then the warrants, they will start trading with pretty exceptional value as well. And as you remember, in the unit, you get warrants also. So some caution here, as we indicated in our Accelerate Arbitrage Fund, the way that we affect SPAC arbitrage is we never hold post-closing. We want to buy pre-deal and then exit prior to closing because we get to capitalize on that redemption, which is basically a built-in put option, which confirms the arbitrage and eliminates downside risk for us, basically. But what happens when a SPAC closes its business combination? It changes from a blank check company to what we call a post-SPAC equity, where it's free to trade wherever it's going to trade. You don't have that redemption option, so it can trade far below $10 per share. So it's really just kind of set in the wind to do its own thing. So it goes through this de-SPACing process where it becomes just like a normal stock. And the elimination of this NAV redemption really changes dramatically the risk-reward dynamic. And it goes from a low-risk proposition to usually a high-risk proposition. So if we look at some data on post-SPAC equity trading dynamics, the last 33 SPACs to complete their business combination and go on to trade, average return of 22%, which is fairly nice. But these follow somewhat of a Pareto distribution that you'd find in venture capital, where you have a few winners but a lot of losers. So median return of -1%, so below that $10 IPO issuance. So the way that it works is basically most of the alpha is in the pre-deal SPAC stage, and then you're seeing kind of more so poor economics on the post-deal de-SPACed equity side. Now, SPAC arbitrage is a strategy that I consider simple but not easy. There's a lot of things that can go wrong if you don't know what you're doing. It requires very careful management. Basically, you need a team full-time to be analyzing and trading these things, because if you miss any key date, then there's major risk in the strategy. I have individuals and even institutional investors reach out pretty consistently saying, wow, this SPAC's down at $7. Why is it down 30% today? I thought it was low risk. And I go, look, you missed the redemption date and you're out of luck. You lost a lot of money on this one because you weren't doing it right. So it's really important to have a very detailed and careful process to keep track of all the key dates, all the key filings, and when you need to get your redemption in, when you need to be exited of the SPAC, and when you need to be selling, when you need to be buying. So caution investors that if you don't know what you're doing, then certainly you can lose a lot of money. Simple strategy, but not easy. Very labor intensive and requires a ton of expertise and a substantial model. We go through every single document filed, and we have over 250 of these modeled out, every single one in the universe in excruciating detail. So it's certainly a powerful tool, which gives us a huge advantage over the market. Many people ask, well, how did SPACs hold up in Q1? Because Q1 was the most volatile market on record. So it serves as an exceptional test ground to see how this asset class did in that environment. So we track a SPAC index, which is every SPAC in the universe equally weighted. You can see that in the blue line. We compare that to the orange line, the global bond index, Barclays Global Ag. So if we look at the bond proxy, the index, bonds returned over the first 5 months of 2020, 2.1% with volatility of 7.7% and a peak drawdown of nearly 9%, as you can see in the orange line. Compare that to SPACs over the first 5 months. SPACs had a 3.8% return. So by April, we're already hitting new all-time highs with a volatility of just 5.3% and a peak drawdown in the most volatile market of all time of less than 7%. So compared to bonds, not only did SPACs outperform by nearly 200 basis points, but did it with 31% less volatility and a 25% lower drawdown. So certainly earning their stripes. I think Q1 2020 showed it, how this asset class really held up for investors and provided that safety and that low risk nature. The other great thing about this asset class is over the first 5 months of 2020, our SPAC index was actually negatively correlated to both stocks and bonds, which is indicative of the benefit of diversification. They say that in investing, diversification is the only free lunch, and what diversification means is including uncorrelated asset classes within a portfolio to lower risk and increase risk-adjusted returns. So we believe, due to those factors, SPACs are an attractive candidate to help diversify portfolios. Then in terms of who's the natural buyer of SPACs, and they're really peculiar type of security because there are no natural buyers really. You wouldn't have a growth investor involved because there's no revenue growth, there's no operating business. You wouldn't have value investors involved because there's no cash flow or earnings to seem cheap off of. You can have quality investors involved because there's no management in the SPAC, just a blank check company, and an index and theme ETFs can't buy them because it doesn't have a theme yet. But they're very similar to risk arbitrage opportunities. So naturally, SPACs attracted arbitrageurs such as myself and some of our competitors. And there's a circle of life to SPACs. So SPAC arbitrageurs, hedge funds, you can think of them as providing bridge financing to a sponsor, because a sponsor is partaking on this journey to earn these extremely lucrative promote compensation, right? And they need someone to give them money, i.e. to crystallize that compensation. So hedge funds, SPAC arbitrageurs come in, basically have an agreement with the sponsor that say, okay, we're gonna park cash with you for as long as 2 years, but we need to be compensated well for it. That's why we get overfunded trusts. That's why we get warrant kickers. And that's why we're able to earn exceptional returns off this strategy, because the sponsor has this extremely lucrative promote, but they need someone to provide the capital to earn it. And hedge fund SPAC arbitrageurs are there to do that. Once the sponsor announces a business combination, it's their job to generate excitement about the story and market it well such that retail traders come in, bid the stock up above net asset value, bid up the SPAC, allowing hedge funds, SPAC arbitrageurs to exit at a premium, and now retail traders are the key holder of the SPAC. And then by the time it finishes, completes the deal, the hedge funds have exited. Now the retail traders are exiting to mutual funds and ETFs that are now coming into the stock as it completes its business combination and becomes a post-SPAC equity. Now, how to access SPACs? It's a good question. There are some private hedge funds doing it. Typically, they're relatively high cost with poor liquidity. Accelerate does offer the Accelerate Arbitrage Fund, which is the only SPAC-focused ETF out there. We have a portfolio of more than 115 SPACs in the book, so super well diversified. We love the risk reward proposition. The fund's up almost 20% this year. It does pay a great yield. That is 3%. We just boosted the distribution by 13.3%. Still reward investors with a mix of capital appreciation and yield. The best thing is that yield is tax efficient for taxable Canadian investors because it's through capital gains, not interest income. So some advisors are seeing it as a good alternative to fixed income products such as bonds and preferred shares, because we have that steady return profile without massive drawdown risk, and we produce that steady yield paid out on a quarterly basis. We've run the strategy for 7 years, so long-term track record, but we relaunched it as an ETF in April, so it trades under ticker ARB, Accelerate Arbitrage Fund, on the TSX, offers investors really easy and low-cost access to this asset class. In comparison to hedge fund competitors, it has no performance fee, charges a management fee of just 0.95%. And that basically summarizes the presentation. To conclude, SPACs, I mean, if they're not on your radar, they should be by now. There's a $100 billion asset class growing seemingly every day. There's over 250 out there. You read the news, they're in the news every single day. From an investment standpoint, they offer arbitrageurs extremely compelling risk-reward dynamics where you get this baseline yield, a very low risk proposition, plus this is exceptional upside optionality. On the supply-demand dynamics, the sponsors get this very lucrative compensation scheme, and then the buyers of post-SPAC equities get the late-stage VC type growth opportunities that they haven't had access before. And from an investment standpoint, we think it's a great diversifier. It provides an attractive yield, but has exhibited diversifying qualities such as low or negative correlation and low drawdown risk. So SPAC arbitrage, it presents equity upside combined with the risk profile of treasury bills. So we really like the risk reward dynamics. And that's why we think investors should consider a diversified portfolio of SPAC opportunities within their asset allocation. And if you want to chat more about it, you can contact me or my colleague Sean. We have our contact information at the end of the presentation there. Check out our website, accelerateshares.com. We produce a ton of content regarding SPACs. We have a weekly podcast, Absolute Return Podcast, where we generally talk about SPAC deals, M&A, things of that nature, sometimes feature special guests. If you want to know more about our alternative ETF, ARB on the TSX, feel free to reach out. I'm going to get to questions now. Got one from Mehul. He stated, is this another fad or are SPACs here to stay? It's hard to say. I definitely think they're here to stay. However, I think the current frenzy, it won't keep up at the current pace that we're at. I think we're going to see a slowdown, but this asset class will continue into the future. No other questions for now. So I thank you all for joining the webinar. We do have CE credits for you, which will circulate in about a week or so. If you do want a copy of the recording, we have that as well. And so thank you for joining us on the webinar. I hope it was informative and wish you the best of luck. Feel free to reach out if you'd like more information. Hope you have a great day. Goodbye, everybody.